Welcome to the Deep Dive. We're all about getting you the important info fast and effectively. Today, we're taking a close look at HDB Financials, specifically their recent Q1 results, our mission. To really unpack those key financial updates based on the recent Q1 results for HDB Financials and figure out what they actually mean for the company.
Exactly. And we want to go a bit beyond just the raw numbers. We'll bring in context, talk implications, really get you thinking about what this data is telling us.
Okay, so the initial picture, right? Based on these Q1 FY26 results, HDB Financials had a, let's say, modest quarter. This is right after their listing, too. Top-line takeaways. Profit dipped a little, but loan growth looked pretty healthy. Margins ticked up slightly. And then there's this moderated asset quality, plus credit costs went up. But the valuation seems reasonable. So kind of a mixed bag, yeah.
Definitely a mixed bag. Lots to unpack there.
All right, let's unpack it then. Let's get into the detailed quarterly snapshot. We're comparing Q1 FY26 to Q1 FY25 here. Time to look closer at the actual figures.
Right, and it's how these numbers interact that tells the real story. Let's zoom in. Net interest income, that's the core earnings from lending it, saw a solid 18% jump year over year. Went from about rupees 1,768 crore in Q1 of FY25 up to rupees 2,092 crore this Q1. That's, a decent rise. Non-interest income, so fees and things, that also rose about 8% year over year.
Okay, so far so good on income streams.
Well, yes, but then you look at costs. Total expenses went up 15% year over year. Now, despite that, the pre-provisioning operating profit, PPOP, it actually grew 18% year over year. So operations before loan losses looked okay.
But the loan losses. That's the provisioning part.
Exactly. And this quarter, credit cost was the big story. That's the money set aside for potential bad loans. It jumped 63%, 63 year over year, from rupees 412 crore to rupees 670 crore. That's a huge increase.
Wow, 63%, that's significant.
It really is. And that, combined with a drop in net BPO income, that's their business process outsourcing stuff, down 22%, it really dragged down the final number. So net profit ended up dipping by 2% year over year from 582 crore down to 568 crore.
So even with good core income growth, that massive jump in credit costs basically wiped out the gains and then some. That's the key takeaway.
Yeah, it's a huge part of it, yes. It really hit the bottom line.
What about the loan book itself? Disbursements versus total loans.
Right. So while profit dipped, the total gross loans actually grew nicely, 14% year over year. Went from around 95,600 crore to over 1,009,000 crore. So the overall book is expanding.
Okay, that's a positive.
But disbursements, the new loans they actually gave out during the quarter, they declined by 8% year over year.
So the existing book grew, but they issued fewer new loans.
Precisely. So, connecting the dots. Healthy overall loan growth, a small margin uptick, but profit declined. Why? Mainly that big spike in credit cost and also elevated operating expenses. It's a classic situation, really. Growth is there, but the cost of managing risk and just running the business offsets some of it.
That makes sense. The slowdown in new loans plus rising costs tells a story about the current climate, maybe. Okay, let's shift gears a bit. Let's talk about what's driving this. Loan growth, sure, but also the type of loans HDB has. And it's worth noting, the stock itself is trading, 10% above its issue price? And the valuation is seen as reasonable, like 2.8 times FY27 book. Potential upside there.
Right, so digging into that loan growth, management doesn't give exact guidance, but historically they grew fast, like a compounded annual growth rate, CAGR, of about 20.3% between FY22 and FY25.
That's quite rapid growth.
It was. Now, Q1 FY26, as we said, 14% year-over-year growth in gross loans, up to that 1,009,342 core mark. And a really important detail, 73% of those loans were secured as of June 30th, 2025.
Secured, meaning backed by an asset. Less risky, generally.
Generally, yes. And also keep in mind, Q1 is usually slow for vehicle financing, which is a big part of their business. So that 14% growth came despite that seasonal dip. They also have a pretty diversified loan book, commercial vehicles, construction equipment. That's the bulk of their assets under management, their AUM. If you break it down for Q1 FY26, enterprise lending was about 39%, asset finance 38%, and consumer finance 23%.
So mostly business and asset-backed lending.
Yeah, about 77% combined. It suggests a focus on areas maybe seen as less risky than, say, purely unsecured personal loans, though consumer finance is still a significant chunk, almost a quarter.
A balanced approach, maybe? Trying to manage risk while still capturing consumer growth?
Seems like it, especially since management has expressed caution about unsecured lending. This mix kind of reflects that.
You mentioned disbursements were down 8% year over year. Why was that, and what's the outlook now?
Yeah, that decline was mainly driven by fewer commercial vehicle or CV loans. That segment's seen a bit of stress on the asset quality front lately.
Okay, so they pulled back a bit there. Makes sense if quality was slipping.
Right. Looking ahead, though, the outlook seems a bit brighter. Things like a stable monsoon, better farm incomes, that should boost rural demand, including for vehicles. Plus, recent interest rate cuts could help private consumption, boosting the consumer finance side. Although, again, management seems cautious on going all in on unsecured stuff.
Right, playing it a bit safe there. Okay, now let's pivot to margins. This is often where the real profit story lies for financials, isn't it? Margin expansion.
Absolutely. And this is where it gets quite interesting for HDB's future prospects. Their net interest margin, or NM, actually rose in Q1 FY26, got up to 7.7%.
Okay, 7.7. How much of an increase is that?
It's a 10 basis points expansion compared to Q1 last year. Not huge, but positive, and it was mainly driven by getting higher yields from a better product mix.
And what about funding costs? Did the rate cuts help there yet?
Not fully in Q1. The full impact wasn't reflected yet. But the expectation is that their funding costs will decline further. And their borrowing mix helps here. It's well spread out. About 39% from NCDs, another 39% from bank loans.
NCDs being non-convertible debentures.
Correct. And the rest is a mix: commercial paper, ECBs, perpetual, and sub-debt. Quite diversified. But here's the kicker. About 90 to 95% of their borrowings are floating rate. They're linked to the external benchmark lending rate, the EBLR.
So if the benchmark rate falls,
their borrowing costs fall. Exactly. But, and this is key, nearly 70 to 75% of their loan book is on fixed rates.
Oh, I see. So costs go down, but income from loans stays roughly the same, at least immediately.
You got it. No immediate downward repricing of most assets. So as funding costs potentially fall further, while yields stay put for a while.
A margin expansion. Wider spread between what they earn and what they pay.
That's the expectation. It looks quite likely in the upcoming quarters based on this structure.
That does sound like a powerful tailwind for profitability.
Mm-hmm.
Are there any potential flies in the ointment? Anything that could derail that?
Well, nothing's ever guaranteed in finance, right? Market rates could behave unexpectedly, competition could intensify. But based on the current setup, their portfolio structure, the outlook for margins does look pretty strong. It's definitely a positive factor.
Good point. Always good to consider the what-ifs. Okay,
Yeah.
Sticking with metrics, what about other key ratios? Any significant moves we should note?
Yeah, a few things changed. We mentioned NM went up to 7.7%. Operational efficiency saw slight improvements too. OPEX operating expenses relative to total gross loans actually decreased a bit from 3.9% down to 3.8%, and the cost-to-income ratio also improved slightly from 43.2% down to 42.7%. So managing costs a bit better.
That's good. Efficiency helps the bottom line.
It does. But then we look at asset quality again. Gross Stage 3 loans, basically the non-performing ones as a percentage of total loans, that increased. Went from 1.93% in Q1 last year to 2.56% this Q1.
Okay, so a noticeable rise in NPAs.
Yes. And Net Stage 3, which accounts for provisions already made, also rose from 0.77% to 1.11%. And related to that, the provisioning coverage on those Stage 3 assets actually decreased from about 60% down to 56.7%.
Meaning a slightly smaller safety cushion for those bad loans?
Kind of, yes. And remember the credit cost metric we talked about. As a percentage of total gross loans, it jumped from 1.8% to 2.5%. So putting it all together, especially with those higher credit costs, the return on average assets, ROA, took a hit.
Right, the overall profitability measure.
Yeah, ROA decreased from 2.4% in Q1 FY25 down to 1.9% in Q1 FY26.
So what does this all mean then? Focusing on that moderation in asset quality, how badly did it impact things?
It was definitely a key factor for the quarter's results. That rise in gross NPAs, Stage 3 assets, to 2.56%. That directly led to needing higher provisions. Those provisions jumped 63% year over year, like we said. And that translates directly into that higher credit cost of 2.5%, up from 1.8% a year ago.
So the worsening quality directly forced them to set aside a lot more money.
Pretty much. Now, delinquencies were seen particularly in asset financing and the unsecured book, but, context matters. Overall, the metrics are still seen as relatively controlled. And the provision coverage, even though it dropped, is still considered comfortable by analysts.
Okay, so not panic stations, but definitely point of pressure.
Exactly. And it directly impacted profitability. That ROA dropped to 1.94% from 2.4%, primarily due to those higher credit costs. There's a small note, too. The asset base included about 9,000 crore from an offer for sale, an OFS, at the quarter end. If you adjust for that, the ROA looks slightly better, maybe 2.02%.
An accounting adjustment.
Sort of. But the main point is, looking forward, ROA could get a boost if margins expand as expected, and if credit costs potentially come down or stabilize.
Then profitability could improve again.
That's the hope, yes.
Fascinating how all these pieces fit together. It really shows you need to look under the hood. Okay, let's wrap this up by looking at valuation. What's the market thinking, and what could shift that?
Right. So the current market price, around rupees 815, puts the valuation at about 2.8 times the estimated FY27 book value. That's on a post-money basis. And analysts generally consider that reasonable, especially given the ROE, return on equity, is around 13 to 15%, and there's that potential for profit improvement we just discussed.
Reasonable, but how does it stack up against competitors?
That's where it gets interesting. On a relative basis, HDB is trading at a discount compared to names like Bajaj Finance, Cholamandalam Investment, and Sundaram Finance.
Okay, why the discount?
Well, the discount to Bajaj Finance is kind of understandable. Bajaj just has much higher profitability, a higher ROA, so you'd expect it to trade at a premium. But the discount compared to Chola and Sundaram, that seems largely down to one specific thing, a draft circular from the Reserve Bank of India, the RBI.
Regulatory uncertainty again. What's this one about?
It came out October 4th, 2024, and it basically tries to stop banks and their related financial companies like HDB, which is linked to HDFC Bank, from having too much overlap in their core businesses.
So the RBI wants clearer lines between the bank and its finance arm.
Essentially, yes. Prevent potential conflicts or maybe systemic risk concentration.
Right.
And this draft circular is creating what analysts call a valuation overhang. It's like a cloud of uncertainty hanging over the stock price.
And what would happen if this circular goes through as drafted?
If it's implemented in its current form, it might require HDFC Bank to significantly cut its stake in HDB, maybe down to below 20%, unless they get specific RBI approval for a higher threshold.
Wow, that would be a major change in ownership structure.
Huge. And that uncertainty is why there's a discount compared to peers like Chola and Sundaram who don't have this specific issue.
But what if the circular doesn't happen like that?
Yeah.
Or gets watered down?
Well, that's the potential upside. If the circular doesn't take effect in its current strong form, then that valuation discount HDB has could narrow significantly. Because fundamentally, HDB benefits a lot from being backed by HDFC Bank, lower cost of funds, strong parentage, things that normally justify a higher valuation, not a discount.
So the resolution of that RBI circular is really the key thing to watch for HDB's valuation relative to its peers.
It's a major, major variable right now, absolutely.
What an illuminating deep dive. Based on the recent Q1 results for HDB Financials, we've really seen the push and pull, haven't we? Profitability pressures from credit costs, but healthy loan growth. An interesting margin outlook, tempered asset quality, and this big regulatory question mark hanging over the valuation. It really highlights how complex analyzing these companies can be.
It absolutely does. And it leaves us, and you listening, with a really interesting question to think about. How will future interest rate moves, combined with whatever happens with that RBI draft circular, ultimately shape HDB Financial's path from here? That interaction could be really unique.
A great final thought. Thank you for joining us on the deep dive. And just a reminder, we are not SEBI-registered financial advisors. If you are considering making any investment decisions, please make sure you consult a certified financial advisor first.